Good evening. Let's dive right in with the jobs report. The U.S. added 353,000 new jobs in January. That is much higher than economists were predicting, and uh, it shows a jobs market and by extension an economy that is even stronger than we'd already known. So the US in November and December of last year added a few 100,000 additional jobs in each of those months, but it didn't come close to the 353,000 that we added in January. So the January jobs growth exceeded expectations. It exceeded what we've been doing. Meanwhile, the reports from 2023 in terms of job growth actually got revised, and we already knew it was strong. It actually is stronger than we realized. Previously, the reports for job growth in 2023 came to 2.7 million new jobs added in total. That has actually now increased to 3.1 million new jobs added in 2023. So unemployment is still at 3.7%. It is now 3.7% for 24 consecutive months. In my last podcast episode, I said that, which actually aired today, that unemployment is at its lowest point in 50 years. That is still true, but we are actually now we're not quite there, but we are almost at our lowest unemployment slash highest employment in 70 years. We haven't quite hit the we're firmly at the 50-year mark. We haven't quite hit the 70-year mark, but we're close. So we have an already strong situation that is getting even stronger. So what does this mean? Well, for one thing, the Fed chair, Jerome Powell, Jay Powell, has hinted that, of course, this past week, January 30 and 31st, the Fed had a meeting, and as widely expected, they left interest rates locked where they are. Their next meeting is in March, and pretty much at this point, everybody is expecting that they're also going to leave interest rates steady at their March meeting as well. The next meeting after that is April 31st and May 1st, that borderline of April and May. And Jay Powell, the federal Fed chair Jay Powell, said he hinted that that's the earliest. I mean, to the extent that he can really hint this, he hinted that the April 31st, May 1st meeting is the earliest that we could really expect to see interest rates decrease. So it looks like with such a robust economy, with the jobs report even stronger than people had originally expected, that interest rates are going to stay high for a while. So it's kind of a mixed bag. A couple of other things to point out before we go into a discussion about that. The average hourly wages have gone up. So average hourly wages grew 0.6% overall. But in January, the average hourly earnings actually exceeded. So we don't have January CPI, Consumer Price Index numbers yet, because today I'm recording this on February 2nd. Oh, it's Groundhog Day. Happy Groundhog Day. I'm recording this on February 2nd. So as of today, we don't have the January Consumer Price Index numbers yet, but we do have December CPI, which was 3.4%. And we do have January's average hourly earnings, which hourly earnings went up 4.5% in January. Now, that's there are often raises and bonuses that are given out around the holidays. It's common for hourly earnings to tick up in January, but we are seeing, at least in the short term, wages actually rise above the level of inflation. Again, in the very, very short term. If you look at a graph of how we've been doing over the past year, it's flipped. It's the opposite. Wages have not kept pace with inflation, but in the very short term, wages have actually exceeded inflation. So we're seeing data that points to people having more purchasing power. So again, what does all of this mean? It means we can expect interest rates to stay high to remain where they are for longer than we might like, until at least May. And if you recall, the Fed raised us to where we are now over the span of 11 rate hikes. So it took 11 rate hikes for us to get to where we are. And that means it's not unlikely that it would take a series of maybe a dozen or so rate cuts to get us back down to where we were. And it's highly unlikely that we will be back down to where we were at any point in the near future. But even when interest rates do start to decrease, which likely won't even begin until May at the earliest, that it will probably be a relatively small decrease, maybe 25 basis points, maybe 50 basis points. And those decreases will probably be incredibly incremental, assuming that the economic data moving forward remains as robust as it is right now. Now, one thing I should say about the jobs report is that there are a lot of economists who believe that the jobs report, and this is something, there's not consensus on this. This is the type of thing that people like to argue about at conferences. But there is at least a vocal subsection of some economists who believe that the jobs report is actually a better indicator of how an economy is doing than any other metric, including the GDP. And of course, that's a controversial statement. Everyone's got their take on that. But the reason that some people say that, the reason that some people will make that argument is because the GDP data has so much going into it that involves oftentimes it involves spending at the business level. You know, it involves things that are happening that are really outside of that are highly Wall Street and not very Main Street. And so you can have really robust GDP data and, you know, a booming stock market, and you can have all of these signs of a great economy, but the average person, the average Joe and Jane, don't feel that great and don't have a lot of consumer confidence, or, you know, they've got low consumer sentiment. So the jobs report, many economists will argue, is a better indicator of how an economy is performing, because the jobs report is the major piece of data that is truly Main Street. The fundamental thing that people care about is, do I have a job, right? If I want a job, can I find one? If you want a job and you're looking for one and you can't find one, that pretty much dominates your life, obviously. There's very little that you would ever even think about outside of, I got to go get a job, right? So that is why a lot of economists believe that the jobs report is really has its finger on the pulse of how the ordinary person is doing, the ordinary household, much more so than GDP data, which can be a little bit removed. There's also, through the University of Michigan, a consumer sentiment index, and that measures something different. It measures consumer confidence. So while the jobs report measures whether or not people who want jobs are employed, the consumer sentiment index from the University of Michigan measures how people feel, the psychological sentiment about their finances. And I think a combination of those two can give a really good indicator of how ordinary Americans are feeling. What we know is the jobs report is really robust. Consumer sentiment is weaker than historic norms. It's actually 7 percentage points lower than its historic average. So that actually is not good news, but it has been improving. So, you know, consumer sentiment is weak, but getting better. Car insurance. Totally changing gears. We've talked in other videos about how inflation is a lot lower than it has been for many years. Not many years. A lot lower than it has been in the recent previous years, right? See if I have the data on hand. Right. Personal consumption expenditures rose 2.6% in December, and core inflation minus food and fuel, that climbed 2.9%. So we are in terms of inflation, we're not at 2%, but we are, 2.6%, 2.9%, we're inching quite a bit closer. But there's one particular expense that affects almost every American between the ages of 16 to 80. And that is auto insurance. And the cost of vehicle insurance, the cost of auto insurance has dramatically increased. Nationwide, Car insurance has gone up 17%, but that has not affected all states equally. And if you live in Florida, I'm looking at you. In parts of Florida, vehicle insurance has gone up as much as 88%. Um, ouch. So, why has car insurance in this era where inflation generally in other arenas seems to be quite a bit more under control? Why has car insurance inflation gone up so much? The reason is that auto insurance is a lagging indicator of inflation. So, what happens is cars are more expensive to buy, therefore more expensive to replace. They're also more expensive to repair and maintain, right? So as those costs have upstream have risen, then downstream, when it comes time for premiums to adjust, downstream premiums have to adjust to keep up with the increased cost of repairs, maintenance, and vehicle replacement. On top of that, medical expenses have also gone up. That is a part of car insurance. So downstream, car insurance has to adjust to reflect that as well. On top of that, weirdly, and this has nothing to do with inflation at all, but there's a spike right now in vehicle theft. So vehicle theft has grown just over the span of the past year around 30%. So that also freakishly has compounded the situation. All of that has come together to make auto insurance way more expensive than it has been than it was last year. So if you are, if you're tuning into the news about the economy and you're hearing people like me say, "Hey, we're at 2.6% inflation, isn't that great?" And then you get your car insurance bill and you're like, "Are you kidding me? Are you freaking kidding me?" You would not be faulted for thinking that. That is absolutely 100% true. But the fact that car insurance is going up so much right now is not an indicator of current inflation. It's actually a lagging indicator of past inflation, a lagging indicator of last year's inflation that is finally catching up with us. Sorry. It's bad news, but it's true. There's a question that I got from my last First Friday video that I wanted to address. And so that question, it was left in the comments. I thought it was a fantastic question, and I wanted to talk about it live. And so the question is, since we know that in the long term, the US markets always go up, why should we be excited that the market is at an all-time high? This has been happening regularly for the last 120 years. That's a fantastic question. So let's address it. And there are really two ways that we can talk about this. One is there's really two frameworks. One is we don't necessarily need to care. In theory, and there's a distinction between what is true in theory and human behavior and human psychology, right? In theory, you could be Rip Van Winkle, Legend of Sleepy Hollow, right? You could go to Sleepy Hollow in upstate New York and fall asleep for, how long was Rip Van Winkle asleep? 20 years? Fall asleep for 20 years. Was he asleep 20 years? 80 years? However long he was asleep. We'll say 20 years. Fall asleep for 20 years, wake up 20 years from now, and boom, assuming that that somehow you were earning an income during that time and that you were regularly dollar cost averaging every single month or every single paycheck, and that your investments were going into passively managed funds in an asset allocated manner, a nice mix of equities and bonds, for example, whatever your asset allocation is that's consistent with your timeline, right? Assuming that you had all of those principles in motion, right? And all of those automations set up, you could absolutely be Rip Van Winkle, go to sleep for 20 years, forget about it, ignore it, and then wake up one day and be in a fantastic state, be ready to retire. That is, in theory, 100% the case, at least assuming that the U.S. market performs in the future in the way that it has in the historic past, the way that it has historically. But human psychology, behaviorally, we get in our own way. And there are two ways that we tend to behave. As a broad population, people tend to become exuberant when markets are rising. And so, as a broad population, we tend to pile into investments when other people are also piling into these investments. And if you want some examples, remember how hot crypto was in 2000, 2001? And it seemed like everybody at the Thanksgiving table was talking about Bitcoin and Ethereum and Solana, right? That was the hot. It was rising, and therefore everyone was talking about it. And because we heard so many people talk about it, more people wanted to get into it. Now, nobody's talking about it. Bitcoin has started going up, and so people are once again beginning to talk about Bitcoin. Why? Because it started going up again. When it was in the dumps, no one wanted to talk about it, and we weren't seeing a lot of new investment in it. And I don't want to pick on Bitcoin and cryptocurrencies. We see this in all types of asset classes. Remember when real estate crowdsourcing became a huge investment fad? This was like 2016, 2017, and all of the websites where you could contribute to a 250 apartment complex in Sarasota, or a strip mall in Madison, Wisconsin, right? All of those real estate crowdfunding, real estate crowdsourcing websites, it like blew up around 2016, 2017. And there was a moment, and by moment, I mean maybe a year or two, where that was all, I mean, anecdotally, that was all I ever heard people talk about. Well, what crowdfunding. And now no one talks about it anymore. Amazing. Similarly, the website VRBO, Vacation Rental by Owner, has been around since at least the 90s. I mean, it was like one of the early websites. But it wasn't until Airbnb came on the scene, which was, I don't know exactly when they were formed, but it was around 2012, approximately 2012, 2013, when people were really talking about it, which doesn't make any sense because you could have been using VRBO this whole time, right? You could have been using VRBO back in 2003. But something came along, Airbnb came along, made it sexy, and now everybody wants to invest. So we are driven by trends, right? Those three examples that I just cited, cryptocurrency, real estate crowdfunding, and Airbnb, those are all examples of investing trends. And investments tend to trend when they're rising, right? Airbnb was in its hot period of growth as a company. And likewise, that was precisely the era when everybody wanted to Airbnb. So what we know in the general population is that when assets rise, people get excited about investing. And we also know that your contributions are the single biggest determinant of your investment success, right? And so, you could sit around trying to optimize your asset allocation all day long until you're blue in the face, but all of that effort pales in comparison to contributing an extra $1,000 a month above and beyond what you are already currently doing, right? So we know that your contributions are the single biggest determinant of your portfolio success. And we also know that people get the most excited about making contributions when assets are going up. So in the general population, when assets are going up, when equities are rising, when stocks are hitting new highs, that's when everyone's like, you know what? The $300 a month that I've been spending on beer, I think I can put at least half of that into the market. Yeah, you know what? I think I'm gonna increase my contributions by an extra $150 a month, right? And that happens right at the moment that you're excited about it. And if you can take that motivation and translate it into automation and make that extra $150 a month, or heck, $300 a month, or however much it is, make that an automatic contribution, then you have just set yourself up for a win, for an ongoing, sustainable, systematic win. So in the general population, that's what tends to happen. People contribute more and people invest more when markets are rising. And there's a lot of data to show that contributions from individual investors increase when markets are going up. Also, likewise, anecdotally, inside of the FIRE community, the Financial Independence Retire Early community. I don't have any data to back this, but anecdotally, what I have seen is that when markets are falling, that's when I tend to hear the most enthusiasm from people inside of the FIRE community. Because when markets are falling, they take the contrarian position and say, hey, everything's cheap. This is the moment that I want to take that $300 beer budget. And you know what? I should be cutting back on my drinking anyway. I'm only going to drink $150 worth of beer a month. And boom, the rest of it I'm going to start putting into the markets, right? So whichever one gets you excited, like what's important is that you get excited about contributing to the markets, whether it's the rising market that gets you going or whether it's a falling market that gets you going. That's you. But whichever one gets you excited about making more contributions than you're already making, particularly if you can lock that in, that's what sets you up for the path of success. So that's the reason I would say that's the reason I get excited about an up market. I get excited about an up market because I know that more people are prone to investing at this point, and that's exactly what we all should be doing in order to have financial stability, good financial health, in order to be prepared for retirement or be prepared to send our kids to college. So that's why. So those are the two answers that I have to the very, very excellent question of why should we be excited that the market is at an all-time high? Answer number one, no, you don't have to be. You could Rip Van Winkle it. Answer number two, propel that enthusiasm into additional contributions. All right. That is the live stream for tonight. I want to say hello to the people who have joined us live. Hello. Thank you so much for watching. Thank you for spending this Friday evening with us. I speak like I have multiple personalities with me, but with me and the entire Afford Anything team that you can't see on the screen, but that stands behind me. Thank you for spending it here and being with the community. Thank you so much for watching, and I will see you in the next live stream. I'm going to be live streaming every Friday, so I'll see you in the next one. Bye.